Have you ever wondered how professional traders catch big moves before the trend even starts? In this video, I'll show you one of the simplest but most powerful strategies used by traders around the world, the moving average crossover. We'll break down exactly how it works using this chart, so stay with me till the end, because this could change the way you trade forever. This chart shows a moving average crossover strategy, where two different moving averages, one short-term and one long-term, are plotted on the price chart. The green line represents the shorter-term moving average, while the blue line is the longer-term moving average. When the shorter moving average crosses below the longer one, it creates what's called a short crossover. This is a bearish signal. It tells us that momentum is shifting to the downside, and traders may look to enter short positions. On the other hand, when the shorter moving average crosses above the longer one, it forms a long crossover, a bullish signal. This suggests that price is gaining strength on the upside and buyers are stepping into the market. What makes this strategy so powerful is its ability to confirm trends and help you ride big moves without second guessing. It removes emotional decisions by giving you a clear and mechanical signal. Crossover up means buy, crossover down means sell. It's especially helpful in trending markets, where these crossovers often signal the beginning of a strong move. By following the crossover, traders can enter early and ride the trend with confidence. So why does this crossover strategy work so well? Because moving averages act as dynamic indicators of market direction. When the short-term average starts turning away from the long-term average, it's one of the first signs that momentum is shifting. Many professional traders use this as a trigger to position themselves before the big move happens. Plus, these crossovers act as trend filters. They help you avoid trading against the market. If you've ever been caught buying in a downtrend or selling in an uptrend, this tool can save you from those mistakes. However, there's one common mistake many new traders make. They jump into trades blindly, just because a crossover appears. Don't do that. Always analyze the market structure, identify key support and resistance levels, and wait for confirmation from price action. Use the crossover as a signal, not as the entire strategy. Think of it as a trigger, not a decision maker. Now, let's talk about the best settings for moving averages. For the short-term line, most traders use the 9-period or 20-period exponential moving average, EMA. For the long term, the 50-period or 200-period EMA is most common. These settings are widely respected by institutional traders and are considered standard. So when a crossover happens with these averages, it often creates significant market movement. This strategy works best on higher time frames like the 1-hour, 4-hour or daily charts. The higher the time frame, the stronger and more reliable the crossover signal becomes. Always backtest the crossover strategy on historical charts. This helps you understand how it behaves in different market conditions. Remember, the goal is to trade with consistency and confidence. Now, looking back at this chart, on the left side, we can clearly see a short crossover. The green moving average drops below the blue and price falls soon after. On the right side, a long crossover occurs. The green MA rises above the blue, and the price moves upward with momentum. Both crossovers align perfectly with the start of a new trend and offer high probability entry opportunities. The moving average crossover strategy is one of the most effective tools in a trader's toolbox. It's easy to understand, works across all currency pairs, and suits traders of all levels, from beginners to professionals. Just remember, never use it in isolation. Combine it with support and resistance zones, candlestick patterns, and market structure to improve your accuracy. This chart adds even more clarity by combining key concepts like support and resistance, range-bound market conditions, and breakout confirmation. You'll notice that the market was initially trading in a range, moving sideways between a clear resistance level at the top and a well-defined support level at the bottom. This is typical price behavior when buyers and sellers are in balance, and many traders get trapped here, making premature trades. But the smart money waits for a proper setup, and that's exactly what we're looking at now. In the middle of this range-bound zone, you can see multiple false breakouts and moving average crossovers that didn't lead to strong trends. This is why context matters. Every crossover isn't a trade signal by itself, but something important happens toward the right side of the chart. A crossover is followed by a clean breakout below the support zone, signaling the start of a new bearish trend. This is where everything aligns. The moving average crossover acts as the confirmation, and the breakout of structure validates the trade. The trader enters the market just after the breakout, placing the entry slightly below the support zone to avoid fakeouts. A stop loss is wisely placed just above the previous resistance level to protect against sudden reversals or false breakouts. What's powerful about this approach is the logical risk-to-reward setup. You're risking a small amount above the structure, but aiming for a much larger profit target in the direction of the breakout, ideally near the next support or liquidity level. This gives you a high reward-to-risk ratio, which is essential for long-term profitability. The overall strategy shown in this chart teaches us a vital lesson. Patience and confirmation are key. Instead of rushing into every moving average crossover, wait for it to align with a major breakout from a range, ideally supported by strong price action. This eliminates many false signals and increases your chance of catching a real trend. Combining the moving average crossover with support and resistance zones, as well as breakout confirmation, gives you a complete edge in the market. It's not about trading every signal, it's about trading the right signal at the right time. This smart, structured approach is how professional traders consistently win, while beginners often fall into traps. So the next time you see a crossover happening inside a range, take a step back. Ask yourself, is the price breaking a key level? Is there confluence from structure and trend? And only then should you consider entering the trade. This is how you evolve from guessing to precision, from losses to consistency. Now let's move to this third chart, which beautifully showcases the core concept of the moving average crossover strategy in action, through a sequence of multiple entries, both long and short. This chart uses two moving averages, the red and the blue lines, which likely represent a short-term EMA and a longer-term EMA. The strategy here is clear. A buy signal, long, is generated when the red line crosses above the blue line, and a sell signal, short, occurs when the red line crosses below the blue line. In this image, the first short trade is triggered when the red moving average drops below the blue, signaling bearish momentum. Shortly after, the trend reverses, and we see a clean crossover where the red line crosses above the blue. This is a strong bullish signal, and the market responds with a powerful uptrend, a textbook long setup. As price climbs, another bearish crossover appears at the top, where the red MA drops below the blue again. This short signal perfectly aligns with the end of the uptrend and the beginning of a downtrend, offering another clean short entry. What makes this chart particularly effective is how each crossover correlates directly with a shift in market structure. Each signal is followed by a significant price move in the indicated direction. Long signals lead to upward rallies, and short signals precede declines. This shows the power of using moving average crossovers not just as random entries, but as reliable indicators of momentum shifts. Another key observation here is that this strategy works best when the market is trending. During strong trends, moving average crossovers produce clean and profitable entries. However, if applied during a sideways or ranging market, these crossovers can give mixed or false signals. That's why it's always important to first identify whether the market is trending or consolidating. Overall, this chart reinforces our previous lessons. When used correctly and combined with market context, the moving average crossover strategy becomes a highly effective and simple way to catch trending moves with precision. Whether you're trading Forex, indices, or crypto, this approach can help you build confidence and consistency if you stay disciplined and follow the rules. All three charts together reveal a complete picture of how powerful and practical the moving average crossover strategy can be when used with the right context, patience, and discipline. The first chart introduced the core concept, using the crossover of a short-term and long-term moving average to identify bullish or bearish momentum shifts. It highlighted how these crossovers offer clear, rule-based signals that remove emotional decision-making and help traders stay on the right side of the trend. The second chart took it a step further by showing how these crossovers perform in range-bound markets. It emphasized the importance of waiting for breakout confirmation beyond key support or resistance levels. A crossover without breakout might be a trap, but a crossover that aligns with a breakout from a range, that's a high probability setup. It also introduced proper stop-loss placement and profit target zones, teaching us how to manage risk and maximize reward intelligently. Finally, the third chart brought it all together with multiple real-time examples of long and short trades, clearly marked by moving average crossovers. It showed that this strategy works best in trending conditions and reinforced the need to avoid signals during sideways or choppy markets. Each crossover in this chart was followed by a decisive move, proving that when used with market structure and proper entry confirmation, this strategy can deliver consistent results. Altogether, these three charts demonstrate that the moving average crossover strategy is not just simple, it's highly effective. But like any tool, its success depends on how wisely you use it. Combine it with structure, breakout zones, and disciplined execution, and it can be your edge in the market. So the next time you trade, don't just follow price, follow momentum, structure, and confirmation. That's how smart traders stay ahead of the game. And if you found this valuable, don't forget to like the video, subscribe to Financial Freedom FX, and check out our other breakdowns to level up your trading journey.